11%, paid monthly, from a company that holds billions in Bitcoin. When you see that combination, your brain does something dangerous. It stops asking questions. And that is exactly why we need to talk about STRC today. Because the people who get hurt the most in investing are usually the ones who were excited first and curious second. So let's flip that around right now. Before we get into anything, this is not financial advice. Do your own research, always. Now, let's actually break this down. STRC, sometimes called Stretch, is a security issued by Strategy, the company formerly known as MicroStrategy, the same company run by Michael Saylor that has become famous for accumulating an enormous amount of Bitcoin on its corporate balance sheet. So when most people hear that Strategy launched something paying around 11% annually in monthly dividends, the first instinct is excitement. Bitcoin company, high yield, monthly income, sign me up. But slow down, because what STRC actually is matters enormously before you make any decisions. STRC is not the same as buying MSTR stock, not even close. It is a preferred stock. And if you have never heard that term before, here's the clearest way to think about it. Imagine Strategy's capital structure like a building with 3 floors. The ground floor belongs to the debt holders, the bond holders, the people Strategy has literally borrowed money from. They get paid first if anything ever goes wrong. The top floor belongs to common shareholders. The people holding MSTR stock, they have the most upside, but also take the most risk. STRC sits in the middle floor. It has more protection than common stock in a worst case scenario, but it ranks below the debt holders, middle of the stack, not the safest, not the riskiest. Now, here is something important about the structure. STRC is described as perpetual, which sounds fancy, but just means there is no maturity date. With a regular bond, you know you are getting your principal back after 5 or 10 years. With STRC, that guarantee does not exist. Strategy does not owe you your money back on a fixed schedule. You can sell your shares in the open market, but the company itself has no obligation to return your principal to you at a set date. That is a fundamentally different risk profile compared to traditional bonds. So what about that 11%? The current dividend rate sits around 11.25% annualized, paid out monthly. And yes, that does sound really good, but here is the part that gets glossed over in most conversations. The dividend rate on STRC is variable. It adjusts on a monthly basis. And critically, dividends are only paid if Strategy's board of directors actually declares them. This is not a U.S. Treasury bond. It is not government-backed. It is not insured. The company could lower that rate. In an extreme situation, they could suspend the dividend entirely. Now, is that likely? Not necessarily, but the possibility exists. And with any double-digit yield, you should always ask yourself why it is that high, because higher yield typically signals higher risk. STRC has what is called a stated value of $100 per share. The way the dividend rate adjusts is designed to keep the trading price anchored near that $100 level. The idea is that unlike MSTR common stock, which swings dramatically based on Bitcoin's price movements, STRC should behave more like a stable income product. If the price drifts significantly away from $100, the dividend mechanism is built to help bring it back toward that range. Strategy calls this short duration for that reason. But here's the crucial distinction you need to internalize. Designed to trade near $100 is not the same thing as guaranteed to trade at $100. If investor confidence drops, if Bitcoin has a massive crash, if market conditions change, STRC can trade below that level. Intention and guarantee are very different things. Now let's talk about why Strategy actually created this. And honestly, from a corporate finance perspective, it is a smart move. When a company like Strategy wants to raise more capital, they have choices. They can issue more common stock, but that dilutes existing shareholders. Nobody wants that. They can take on more debt, but that comes with fixed obligations and covenants. Or they can create a preferred layer like STRC. This attracts income-focused investors who want yield rather than stock price appreciation. It diversifies the company's funding sources without diluting MSTR holders. It adds flexibility to the capital structure. Long term, that kind of financial engineering can actually make the company more resilient. STRC is not replacing MSTR. It is building a stronger foundation around it. You might be wondering whether STRC is connected to Bitcoin. The answer is indirect but real. STRC itself is not a Bitcoin product. You are not buying Bitcoin exposure when you buy STRC, but Strategy holds a massive Bitcoin treasury, and the company's overall financial health is deeply tied to what Bitcoin does. So if Bitcoin experiences a severe, prolonged downturn, that affects how investors view Strategy, which in turn affects how STRC trades in the market. The chain is clear. STRC is exposed to Strategy, and Strategy is exposed to Bitcoin. So who is STRC actually for? It fits someone who wants regular income, understands corporate credit risk, is comfortable with indirect Bitcoin exposure, and is not expecting the explosive price upside that MSTR common stock can deliver. If you want guaranteed income with zero volatility, this is the wrong product, full stop. Here are the real risks laid out plainly. The dividend rate can decline. The dividend is not legally guaranteed. There is no maturity date to recover your principal. The price can trade below $100. Bitcoin volatility can shake investor confidence in Strategy, and liquidity may be thinner than MSTR common shares. That is the honest picture. The biggest trap people fall into is seeing 11%, seeing Bitcoin, seeing Strategy, and concluding this must be some kind of safe income cheat code. That thinking is dangerous. STRC is a variable rate preferred stock issued by a Bitcoin heavy company with no principal repayment guarantee. There is nothing magical about it, just structure. And when you understand the structure, you can make a real decision instead of an emotional one. A quick recap before we wrap up. STRC is preferred stock. It ranks above common shareholders but below debt holders. It pays a variable monthly dividend, currently around 11% annually. That dividend can be adjusted or suspended. It is designed to trade near $100, but that is not guaranteed. It is indirectly exposed to Bitcoin through Strategy's balance sheet, and it carries real corporate risk that you need to price in. Understanding what you own is not pessimism. It is the foundation of every smart investing decision you will ever make. If STRC fits your goals and risk tolerance, approach it with intention, not because it sounds exciting, because you actually understand it. If this breakdown helped you, drop a like, subscribe, and I will catch you in the next one.